that now we've been below 20% here for, I want to say, 3 or 4 days. So I don't know if we're saying here, okay, everybody, let's ease up on the fear a bit, but it definitely seems like the market, as far as predictions here, is kind of scaling it back as far as what the fear is looking like.
Yeah, it's interesting. Probably for like the last 3 months or so, I think we've been basically saying the same thing, which was, late into basically the last quarter of last year, you kind of had this VIX, this level between 35 and 45. We actually had this period of pretty high volatility, or relatively high volatility, and then you saw a level shift between like the 35-30 range in the VIX. And basically into the end of the year, with a lot of that light volume, not much, there was not a lot of movement into November, at the end of November and into December, and we kind of had a level shift to start out this year. And we've been trading under 30. So the expectation, I think, from my standpoint, is that we actually saw that level shift at the end of December, and we would oscillate between a 20 and 30 level. So it's interesting, I think, that we're actually breaking this 20 level in the VIX and becoming so cheap in terms of volatility. So I've got to ask, Chris, we've talked about this a couple of times, but now that we're sub 20 in terms of the VIX, I mean, are we basically dependent on whether or not we hold this 1,300 level in the S&P 500?
It definitely is, and when it's funny we talk about this, because it's one of those things where everybody's kind of saying, like, I'm not too nervous yet, but if something happens, I'm getting out of the way. You know what I mean? And you can even see it today. Earlier this morning, the VIX, I want to say, was up over a point this morning, and we weren't down much. We were down 4 or 5, 6, 7 points in the S&P. So it's not like it was a crash by any stretch of the imagination, but that VIX number, I feel like it jumped up more than I would have expected on a move like that. So people definitely aren't panicking. With VIX below 20, I don't think you're ever going to call it a panic. But when you see the reaction on a down move like that in the VIX, it kind of makes me at least think that people aren't panicking now, but they're not kind of wrapping it up yet. They're looking for another sign as far as making sure we have confirmation, this 1320 level or so. If we can break through, I think you'll find a lot of people kind of ease off a little bit as far as their concerns. But if we turn, I feel like people are ready to – nobody wants to be last as far as protecting themselves. And I feel like it's almost going to be a race to cover your positions if people start thinking there's going to be a turn the other way.
It's funny you say that, because it kind of brings up that old saying that the market walks up the stairs and falls off the cliff. But before we get started here, obviously we want to give everyone out there the opportunity to give us a call. Clearly we've got a special guest here on with us in Chris Bolson, so it should be a very fun next 50 minutes. If you want to go ahead and give us a call, 877-927-6648 for all our domestic listeners. Again, 877-927-6648. Give us a call, guys. And whether you want to talk about holding this VIX level, I think the transition here, before we start talking about obviously the SPOOs, the S&P, which as a quick market update, trading 1308 3/4, down 2 1/4 on the day. When you see something, a VIX at the 20 level versus trending downwards from, let's just call it either 25 or 30, whatever you want to say that upper end of the potential range is, how does that change the way you're looking at strategy? How does that change the different positions or the dynamics of the positions you might put on in that type of environment?
Well, most of it kind of goes back to kind of how you were talking before. That 35 to 45 kind of range, and then below that maybe the just over 30 down to about 20 range in the VIX. It's really about trying to use the VIX to determine what kind of strategy are you going to be looking at, and it's not necessarily where are we in the VIX, because trading VIX 20 if we were 13% yesterday versus trading VIX 20 today if we were 25% yesterday, it's two very, very different market environments, right? So it's really looking at if we're below 20, and now we've kind of noticed, and we have the support up there and the different trend lines as far as if we now are thinking, all right, we were on 20 down here at this lower range, and that was support for a while, and it held firm. We finally broke through. It's that same kind of belief. Well, that's a strong area there that we want to keep an eye on, and now it becomes something. Well, if that's resistance, now is maybe a time where you want to start thinking about strategies where you're in a short Vega position. So it's always, I tend to say long theta and selling premium tends to be the way that we look into. But here you also want to incorporate some short Vega, as long as you believe that's the case. Now, the part that scares me, of course, is I feel like if we fall down 10 points, that VIX can really pop up quick. But this is the first indication that maybe some fear is subsiding, and it may be something to kind of play along with as far as trying to covering some positions up here.
And before we transition here and obviously talk about the overall market and jump into obviously some the things that are on everyone's watch list here today in terms of obviously Apple, Netflix, Amazon coming up next week. If you're still taking a look at Google, and by that I just mean kind of if you're looking at playing Apple, you're looking at playing Amazon, you're looking at playing these different tech names, obviously you want to know what happened with Google. So we're going to talk about all those underlying securities as we go forward. But here in breaking that 20 level, and we've had 3 sessions now where we have closed below 20 level in the VIX, which, as you said, kind of made a little bit of support level there in the VIX. So if we're closing down below, and the thought is that in typical technical analysis, very, very simple. You break support, it tends to become the resistance. So when you said a position that may be short Vega, at the same time, you're talking about possibly protecting yourself. It's kind of interesting because you're bringing up 2 different perspectives there. But there are ways that you can put on positions that actually kind of do both, right? They could potentially be short Vega at this level and also protect yourself, if in fact we do see a break of this 1300 level, right?
Right. So the main kind of trend, in the base position that I think a lot of people who trade options are really revolve around 2 very simple positions, and we're talking about non-directional type things. Obviously, if you're taking directional plays, long option straddles or just short verticals or along those lines, those are the plays where Vega and Theta become a little bit less of a concern because the direction is more so the important. But really, there's kind of 2 frames of mind as far as what you're looking at, depending upon if you want a short Vega position or a long Vega position. And really the 2 of them is the iron condor, shorting an iron condor if you believe you want to be in a short Vega position, right? Because you have defined risk. You're selling the downside, you're selling the upside, you're hoping for kind of a neutral market, and 2 things benefit you: the passing of time and decreasing volatility. If both of those things happen, it's going to work out in your favor. The opposite kind of side of that is still the same kind of neutral position, but is a long calendar spread, where you're buying the longer-term option, shorting the front-month option, and what that does is gives you that theta, because that front month, as we all know, is going to decay at a faster rate than the back month, but also gives you kind of a long Vega position. So should the market kind of move aggressively and the VIX increases, you're at least going to get some back from that long volatility position. So this is probably a situation where looking at something now, as long as you think, as I'm starting to think, at least right now, maybe still looking for some confirmation, but I'm starting to move into a point where I'm less concerned about the calendar spreads and starting to look more so at kind of an iron condor, where I'm selling the volatility, getting short Vega, but at the same time still collecting that theta and doing it all with defined risk as well.
So I think that's really interesting, and so many times I think people call in to this show in particular with questions on calendars. I mean, especially when you see volatility that's moving all around, as we've seen over the last 4 or 5 months. Like which opportunity, do I want to take advantage of these at the high points of volatility, low points of volatility, breaks of support, breaks of resistance? And so I think it's interesting that you bring that up. Now, a lot of listeners, as you know, Chris, are tend to have a long stock portfolio, and they might be dabbling in options, or they might be putting options on like an Apple or Google, something where it might take too much capital to actually make an investment in terms of equity, of the equity itself, But what I'm curious about is if we're long stock here, right? It doesn't matter the underlying position. The overall market is sitting right here at support or resistance, whatever you want to call it. Now, we've had a couple closes above 1,300, so I think we'll call it support here. So we're sitting above support, and we're looking at a break of basically what was support in the VIX. So you're saying potentially position ourselves where we're short Vega, and we're also sitting here at potential support resistance, and I'm long stock. So if that's the case for me, how do I either take advantage of that security or that strategy that you've just outlined, or how do I protect myself in case I'm a little bit nervous of a short-term break here at the 1300 level?
Right. So the big things that obviously you want to stay on top of is you're long essentially the underlying, you're long the market, right? So if that's the case and you still want to hold that position, especially if we're talking about we're above support at this point, we've broken resistance, now we're on the top side of support, what a lot of people look at doing is the covered call spread, right? Because you're long the underlying, you can sell a call against that, which essentially brings some premium in. It gets you short the vega, so that you're playing the volatility a little bit, as well as collecting theta. So we can go ahead and certainly look at just the general market as far as selling options against it. I know a lot of people say that there's kind of two things that people get caught up with, and one of them being they say, well, volatility is so low now, it's below 20. What's the point of selling an option? And the whole point about what we're looking at here is if you're going to sell an option, you certainly want to get paid for it. But remembering that as far as what we're looking at here, you're also playing that volatility is going to go even lower. So that's one part of it. But the other part being, if you still have that long directional feel, you still want to give it room to run a little bit. You're going to want to make sure that you don't sell a call that, say, is one in the money or even right at the money. Because essentially, when you're selling that covered call spread, when you're selling just the call portion of it, you're capping how much you can potentially make to the upside. So if you're going to limit that, limit your potential gains, especially if you still feel that the market can move a little bit. You want to keep that limit. One, give yourself a little bit of room to run, and two, you're going to want to get paid for it. I know a lot of people who are, they say, well, I can sell this option for a nickel. That's great. It's not going to expire, or it's not going to be assigned. It's not going to be in the money, but you're only making a nickel, and how much risk are you taking? Like if it actually goes up there, you never want to sell that option for a nickel. You know what I mean? So make sure if you're covering your potential gains, you want to get paid for it, right? It's like the old, what is that, Goodfellas line? Pay me? I won't say the first part of it, right? You want to get paid. You're taking on, you're giving up the potential gains, so you want to get paid for it. You want to be compensated.
And I think, it's so interesting because when you talk about covered calls, even though, where you're positioning, where you might sell that short option, might, from a probabilistic standpoint, you have a high probability of keeping the premium. So many people, even in those cases, are like, I don't want to give up my upside risk. So many people leave money on the table potentially in securities that they could actually generate some income on because they're scared of giving that upside. So it's interesting you bring up covered call spreads where you're actually selling where you would feel comfortable, actually getting called away in terms of the stock, but you actually have this long option out there where if it does make a significant move to the upside, you can benefit to the upside. So I think so many people are familiar with the covered call who might not be familiar with spreads themselves. They're just using it to generate income, and they don't realize that if you actually turn that into a spread, you give yourself the opportunity on the upside to profit in cases where you do have a significant upside move.
Right. So we have Apple on the screen right now, and I'm going to kind of just think about this just a long delta position. So whether you're long the 400 calls, you're long the stock, or whatever the case may be, Victor kind of pointed out is thinking of your exit point, right? So where would you get out of this? And I'll just pull a number out of thin air. We'll say 445 or 450. You can sell those calls, and they're what are they about $5 right now for the 450s? Maybe we never go to 450. Maybe we go to 470. But one of the things you kind of think about is I always do this with clients, and I think about it myself as well, is people say, well, I don't want to sell the 450s because what if we go to 470 or 480? And I say, well, if we get to 450 and you still have your position and you're thinking about are you going to keep it or close it, what are you going to do? And if they say, well, I'd probably close it, well, you can forget about how high it possibly would go because you're not going to be in the position anymore anyway. So kind of think of that as well. If you're going to get out of an option at that price anyway, and again, it's just me pulling one out of the air at 450. Why not get paid an additional, for one option, $500 right now? Because what if we never even go to 450? What if we just stay here at 425, 430? We stay at 425. You can even kind of look longer term. What if we stay at 425 for 3 or 4 months, and you can get that $5 every single month? You know what I mean? You can certainly supplement your income a little bit by selling those calls, collecting that premium, especially if we never get there. You're right. You are giving up some potential upside, but a lot of people when you think about that, how many of us have actually sold the top anyway? You know what I mean? Nobody really picks the very top as far as where they'd get out. In most cases, it goes to 470, and then it goes back down to 450, and you say, okay, well, now I think it's going down, and you sell it then. You know, nobody really gets in on those great spots. So you definitely want to look there. And this is one of them, and you know, I don't really have a basis on Apple, especially not before earnings, as far as playing a direction. But you know, that's a premium if you've had Apple for a while and you're comfortable getting out if we do get gap up that high, and maybe that's kind of the target where you think you're going. At least you're getting paid for it. And if you're wrong, well, you have $500 in your pocket that you didn't have before you put the trade on. So, a couple different things to look at there.
Yeah, so I think that's actually, you know, it's a good transition. I think it's such an important topic, and I appreciate you being with us here, Chris. Dropping some knowledge on the crowd here today.
That's all I got. So the rest of the show is all you.
Improv from here on out. So no, but I think especially at this level, at the 1300 level, and a significant, you know, a potential significant break in what was that 20 support level here in the VIX, and it just where we're positioning ourselves. I think so many people out there are thinking exactly like what you said. You know, I'm not so nervous here because we've had a couple of convincing closes above 1300. Not only that, you saw today where the market was down early, maybe, you know, down $9 in the SPOOs, and you saw, you know, buyers come back in the market and hold that 1300 level. So I think some people are saying here that it's a convincing consecutive close here with decent volume compared to what we've seen over the last couple of months. But I think they are looking for some method of protection. You know, something to potentially give them, you know, some protection on the downside. So you brought up an example, Apple. You know, I think, you know, we've got earnings after the close here today, which is going to be really, really interesting on the heels of Google. Actually, you know, Verizon came out with some numbers is in terms of how well they've done with moving the iPhone, and you've got a lot of analysts out there who have kind of increased their expectation in the number of iPhones that they're expecting Apple to move. I think there's a couple people that moved analysts from about 26 million up to 30 million. And this is why it's so important. We'll jump into the strategy here in just a moment, but this is why it's so important. I think actually, you know, iPhone makes up, in terms of revenue, in a straight, you know, discounted cash model, it makes up 52.5% of Apple's revenue. So the iPhone in and of itself, 52.5% of the revenue, and about 12% comes from the iPad, 12% comes from Mac, and then 4% off iTunes. So why it's so significant to basically understand the number of iPhone units that Apple's moving on a quarter-to-quarter basis, and understand why it's so important that some analysts have increased their target estimate from 26 to 30 million. And then for those out there who are looking for the number, I think the analyst estimate right now is $10.06 per share versus a year ago at $6.43. You know, it's so important that we actually understand what those numbers are, because it makes up such a significant amount of the revenue that Apple's posting on a quarter-over-quarter basis.
See, this is kind of one of the ways, like with Apple, I can talk myself out of any trade in Apple at any time. And part of it is essentially you bring up these numbers, you say like, all right, they're going to revise it up and they're doing better, and it's like they're on all-time highs now. I always have difficulty buying on all-time highs, but it's going to keep going. Like if it keeps going higher, it's not the all-time high where you would have bought it. You know what I mean? So you really have to pay attention to these things. But you look at these and you kind of go like, well, if they can continue to move like they're moving, there's no reason this stock doesn't continue going screaming higher. At the same time, I feel like just news-wise, I feel like anybody's waiting to catch on to say like, oh, it's not as good, or maybe this is a good quarter, but down the road, what's next? I feel like anybody's just waiting to catch on to the news and say, see, Jobs isn't there anymore. Now look what's going to happen. You know what I mean? I feel like at the same time it could really like crash the stock, especially short term. You know what I mean? Like what they've done, what Apple's done as far as revolutionizing essentially the industry that they're in with their products, is they've put themselves in a position where everybody's challenging them, and it's a difficult, very difficult position to stay in. For the amount of time they've been in it right now, let alone to continue from that point. You know, so they have everybody essentially taking shots at them. But I feel like I've been saying it for the last year and a half as far as they can't do it forever, you know what I mean? And what do? They just keep dominating the competition. So.
Right. Well, last quarter actually, they had a little bit of a pullback, around earnings. But the one thing I will say here, you bring up an interesting point. We traded up to like 431 yesterday, which is that high that you mentioned. We're sitting here at a high, and I think the at the money straddle is about $21, $22. Actually, looks like $23 now. At the money straddle is about $23, so the implied move maybe $21, $22 off Apple earnings, right?
Right. Me personally, if I'm looking at earnings play, right, I'm guessing that's where we're going next, right?
Yep.
We're looking at earnings play. I look at whatever the straddle is, expiration week, that's the expected move. Because if we move $23, well, now those things are $23 out of the money, and it's a worthless option. You know what I mean? So I still kind of look at that. That's the expected move, and it's funny that it's $23 because you said 21 or 22, and I'm like, yeah, it was 21 or 22 before I walked to come over here. So it's gone up over $1 in probably the last hour or so. So it's definitely one of them, and that kind of goes to what I was thinking. Really, when I'm looking at weeklies, the only time I'm trading these, for the most part, if it's not some sort of a calendar position or some kind of a quick hedge or something along those lines, and I think the reason a lot of people trade these is taking shots, right? And when you get around earnings, that seems to be something that everybody's kind of looking for. And I know that we talked a little bit about Google. I think I was talking about Google on here a couple weeks ago, but I know we've been talking about it in a few different circles. The Google straddle was like $35, and that moved, I think, over $58
or something,
right?
Like that.
So that was a huge move, and we're looking now at Apple, and it's $23. And you look at percentages, and what's that in percent? Is that 5%? I'm not very good at math. It's a percent, right? So it's essentially it's a big 5%. Move. It's a big move, right? But and it doesn't move more than about 20 points or so on most of its earnings. But I personally feel like everybody's watching this one. You know what I mean? Kind of like the first real quarter earnings cycle without Steve Jobs, and I feel like just more people are watching it. And if they can hit kind of like a home run in terms of earnings, and everybody goes, oh, they can kind of get by without him, I feel like it could go screaming up, because I feel like right now that's kind of what's holding them back, is confirmation as far as that actually being able to happen.
So before we dive in just a little bit more, we're going to talk about Apple. We're going to talk about, obviously, Netflix coming up, which has been, basically the dog of the last half of 2011, but it's posting kind of an interesting rally here to around the 90 handle. And then we'll talk about Amazon coming up next week as well. But if you have questions specifically on Apple, and we know, as Chris said, I mean, if you're not trading it, you're watching it. So, if bullish, bearish, neutral, doesn't matter. Let's talk strategy. 877-927-6648. Again, 877-927-6648. Quick market update here. The SPOOs, the S&P 500 trading 1308 and a quarter, basically 1308 even, down $3. The Dow, for you Dow proponents, 12,608, down 42. Let's see here. Gold trading 1668.50, down about $10 on the day, which is kind of an interesting move. But we've kind of been watching it bounce off that 1600 level after extended to maybe 1575, 1550. And crude, again, sitting here at 98.97. So you haven't been around for these sessions, but that's something I've actually been watching here. We'll jump into Apple. I don't mean to lead us off on kind of a tangent, but one thing about crude oil, and it's been interesting in this range, kind of sitting at 100. It'll back off, go to 101, back off to 98. Traded up to 103, backed off to 98. But the whole thing we've been watching this entire time. Obviously, there's political climate, which is kind of giving us that rally of $5 at here and then. But every time it gets up to the 103 area, I'm looking at the dollar, and I'm not seeing the dollar do what you would think it would do for us to really have $103 barrel of oil. And so I'm watching /DX for those of you out there, which is the dollar index, the dollar weighted against several international currencies. And when we've noted every time we see these moves, we've still got basically the dollar index trading around the 80 handle. So I'll pass it up to you. I don't know if you've been watching it, but we've talked about it a few times.
Right, so that dollar index is essentially kind of rallied to it's been a while since we've been this high in the dollar index. I want to say probably over a year or so, right? So I definitely agree with you, and I think that goes to underscore how important this kind of macroeconomic climate is as far as the pricing of oil. Because in a typical, we've seen it with gold. The dollar rallies, you'll see gold kind of come off in prices a little bit. The dollar sells off, you see a rally in gold. You know, they're working opposite each other. Oil works in much the same way, but there's also a huge supply and demand issue when it comes to oil. You know, nobody's really saying, well, the dollar's rallying, but, you know, I really need gold to, you know, run my business. You know what I mean? Unless you're a jeweler, that's just not the case, right? So, you know, airlines, any company that does anything as far as industrial or whatever, nobody cares about the price of gold. They do care about the price of oil. Everybody cares about the price of oil because it directly affects almost everybody. So we're in a situation now where the dollar is essentially on its highs and oil is also on its highs. So I feel like that goes to reflect, like, imagine if the dollar was weak right now, what that would be doing to the price of oil. You know, would we be seeing $120 or $130 oil? And I would say that that's probably not unreasonable. I'd say where the dollar is now versus where it was a year ago is probably, I don't know, maybe $10 to $12 in the price of oil is where I would estimate. So you see something like that and you say, wow, if the dollar wasn't in a great position, that'd be even worse. And conversely, think of if there wasn't kind of that economic issue as far as the political issue, we'll say, in the Middle East with oil right now, and strengthen the dollar. Imagine how low oil would be at that point in time. So it's definitely something. I'm not trading anything right there in either one of those products, at least not right now. But it's definitely something I'm keeping an eye on, because if you see any kind of weakness in the dollar, or you're expecting any kind of weakness in the dollar, oil's something that I would feel like would increase in value, especially if we don't get any of this stuff cleared up with Iran right now. Conversely, if you still think the dollar is going to continue to strengthen and we're gonna get any of that stuff cleaned up and get some of the uncertainty out of the marketplace, I feel like you could see oil really come crashing back down to earth if the dollar continues to strengthen and there's not that kind of political mess hanging over our head.
So again, and this is why you brought something up here, and then I just want to stress on it. So if you're looking again at crude here at 98, 103, wherever we are inside of that kind of $5 range we've been moving in the last month or so, you feel where is the most interesting risk to reward standpoint in your mind here at this kind of 100 level in oil? Do you feel the risk reward benefits a position which is taking advantage of the upside, or the risk reward benefits positions or benefits someone who's positioning to the downside?
Me personally, I think play it more so to the downside, and the main reason for that is I don't think we get as inflamed as maybe they're kind of posturing for in the Middle East, and I also think that the dollar is likely, you know, barring anything else kind of coming out crazy here, I think the dollar is likely to continue on its upswing. So if you get kind of both of those things lined up, perfect storm, I think you see a move back down to the downside. I'd say the reason that we've kind of stayed still, and you can put your 2 cents in there as well. I want to see where you stand. But the reason we've kind of stayed still is because you have one playing off against the other. So it's almost like if at least you're right on one of them, you're wrong on the other, you're still flat on the trade. You know what I mean?
Yep. No, I think it's like you're going to have news out there on either one, right? It's almost like one or the other. Either you got Iran out there or you've got the European debt crisis. Like one is going to make some interesting headway, and that's why you kind of just like you said, we played in this range because they're almost offsetting each other, which is why we're sitting around 98 and 103. But I agree with you 100%. I think you know, it'll be interesting what we hear out of the State of the Union and kind of the posturing for whether or not, you know, we'll, you know, spend, drill, like whatever we hear out of, you know, tonight. And I don't think, you know, we're likely to hear either. But, you know, my point is that I think the risk to reward favors kind of a downside move. So at 98, I'm less likely to go long here and try to play it for that 5-point upswing than I am at 103 to try and play it for a nice pullback. And I think over the last couple of months, basically over the last couple of shows, I'll say maybe a month and a half, I think we've talked about that on every show. At 98, it's not necessarily going long, but once crude hits that 104, 105 level, it's like, it would be interesting whether you're playing crude options or whether you're playing USO to say, you know, is there an opportunity to play a quick downside move?
Right. I think at least with the volatility in it right now, it's not something you have to press for, right? Because it's almost like, well, maybe I don't think we're going down tomorrow, So I don't feel like it's a huge race to get into a position like this. And it's difficult to plan for that kind of news that would generate that movement anyway. But you can kind of say, well, we're in this range. I think it's going to work out this way, but if there's just kind of moving around in this tight range, you can also say, well, give yourself some time to move. So it goes to just going to speak there as far as you don't always have to have a position on. You know what I mean? Like a lot of times I tell people, kind of looking at this is sizing up. Wouldn't this be a great play? It doesn't mean go put it on right now, or it doesn't mean I'm going to put it on right now. But if it kind of continues to move in your favor, then you're prepared for it instead of trying to scramble and think, is it a good idea or not? It's kind of you realize that something's moved in to the spot you want it to finally put your position on. So, hey, real quick, let's throw out that number one more time. We have it up there. It's 877-927-6648. Anybody, anything you guys want to talk about here, options related? Victor and I are ready to fire away on any kind of strategies or plays you're thinking of, or anything of that good stuff.
So, one of the things obviously coming up here today is Netflix, right? So we have Netflix out there, which, like we mentioned before, has essentially been a dog into the end of last year. I mean, it peeled off more than a couple hundred points, basically from 304 down to the 50 handle, 62 actually. So, we've basically rallied from 62 up until 90, maybe a 50% rally over the last couple months. And I think this one's going to be interesting here at $100. And I'll point out something, and I want to get your thoughts. I've been looking at the option chain here, and one thing I've noted is that there is a larger disparity between the implied volatility as you go out here than there is in many of the other stocks that I'm looking at here. For instance, I'll show something like Apple, and you see, with respect to a forward month where we actually have earnings, you see 60%, and then the back month 35%. You see it relatively stable throughout the chain. One thing I'm noticing here that's not necessarily the case. You don't see that level of stability. You actually see a little bit higher. You see volatility, positive volatility differential as you go further and further back, all the way from 90% down to 58% in the back month. So I'm curious, when you look and you see something like that, Chris, what does that point out to you in terms of what that market is expecting?
Well, there's one thing I want to bring up first is I want to say it was like January 6th or something. I saw on CNBC that Netflix was the top performer for the year of 2012. So if you come from zero all the way back up, you're doing really well. So I want to say they were probably second to worst last year, S&P 500. And they're probably among still the top right now as far as on this year only basis. So what are we talking about, 24 days? But definitely the reason that you see this huge implied volatility, and it's 170% in the weekly, is because nobody knows what's going on with it, right? Everybody's freaking out. To be honest, it's only a $12 straddle. Even that to me doesn't seem like it's that much, but in terms of implied volatility, 170%, and I think that goes to speak as far as how people have gotten burned by this one, right? People have been long from probably this price all the way up to close to 300, and people have been burned on the way all the way back down, and then people have said, okay, well, get me out because it's going to zero. They get out at 60, and what happens? It goes back up to 100. So Netflix is definitely one that people have been burned by, and nobody wants to get burned again. I feel like the volatility being as high as it is, you almost get a feeling where people are saying, well, if it goes down again, I'm selling it because I'm never buying it again. You know what I mean? Because that's why if you see a move to the downside, I really think you're going to see it exaggerated. But at the same time, conversely, if we're just looking to the upside potential, if Netflix does anything, they were written off for dead 3 months ago, right? If they do anything to say they're able to reclaim some of what they had. I mean, it was a $300 stock earlier this year. Is it crazy to say it goes from 300 to 200 over a year with all the bad news they've had? And that'd be up another 100% from where it is right now. So it's definitely something. I'm almost surprised. It's a really expensive straddle at $12. But I'm almost surprised it's not even more than that, because anybody who has a position in Netflix, I feel, will do something tomorrow. You know what I mean? That I would think could really inflate the move of where it goes.
So I think what's interesting here is, if you remember last earnings, they basically mentioned that they were launching some international businesses. So today the revenue breakdown. I know we did the revenue breakdown of Apple, but essentially, again, just a discounted cash flow model. The revenue breakdown in Netflix is about 57% of the revenue comes from streaming subscriptions in the U.S. 57% versus 26%. Basically internationally. If you remember, based on their Q4, they essentially said, going into Q4, that they were taking some hits basically because they were launching their UK and Ireland business, and then the other 14.5% still comes from DVD. So they mentioned, and I think why they took such a huge hit, even on top of their huge move, at the end of 2011. Basically, last time they had earnings, there was that gap from 125 down to about 75 or so. $50 gap down was essentially because they came out and said, we don't know, or we don't anticipate being profitable throughout the end of the year. So today, even though analysts are expecting maybe a 55-cent per share, I think that's the consensus that they come in, and that's also down about 37% from last year. Whether or not they actually come in at that number, I think the probabilities might be a little bit lower just based on what Netflix has said themselves. I think there's probably a low probability in doing that, but I think it's more about how they posture themselves for the rest of the year, what they're doing in terms of cost, how they're increasing membership, and specifically how they're increasing their international membership, because it does make up a quarter of the revenue.
Right. The big thing, all anybody really cares about now, can you gain clients? Can you gain customers? Can you sell this product again? Because I had Netflix. I don't anymore. Do you have Netflix?
They killed me. They burned me, and I'm out.
Right. So, and to be honest, I don't plan on going back. It's not like the service is changing or anything is going to be different about it. So unless they do something drastic or it gets that much better or something, what you really want to see is, can they gain new customers? And if they can, and they can do it at a rate even close to what they were in the past, it's going to be a good company again. And even if all of that is from overseas, or just continuing to do the streaming business, that's what they were targeting to do anyway. That was the goal before this whole mess started. So did they carry it out in the best way? No, probably not, and they probably carried it out in close to the worst way. But if it's something they can actually follow through with, and we can see some of that move back to where they were actually trying to get to, this stock, I feel like that's all anybody cares about. Can you get more customers again?
Let's say you are long here, right? Let's say you nibbled at 60, you nibbled at 70, 80, wherever it is, and you've had a nice little gain up to this mid 90 level as we approach $100, and we're going into earnings tomorrow. And implied volatility is clearly telling that there's some uncertainty not only now but into the future in terms of what we'll actually see. So if I'm long going into this earnings session, how do I use options to potentially hedge that risk? So we talked before about potentially selling covered call or something like that. But if I'm going into earnings, I'm a little bit nervous here. What can I do as a strategy to protect myself if I am long here in Netflix?
Here's one of the things first to at least point out. You can kind of, we look at the straddles, we look at implied volatilities and kind of say, all right, where's this thing going to go, right? Take a look at the money. We'll just use a 92 half strike for right now. And go down, we'll go up and down 7.5 points. If you go down 7.5 points to the 85 strike, it's worth about $3, the puts, right? Look at if you go up to the 100 strike, which is less than 7.5. It's even a shorter move. It's only 7 points to the upside. It's worth $3.50. So it's really surprising. You usually see the inverse of that as far as the skew, the call or put skew. Typically, the puts are going to be higher priced because the fear is to the downside. In this one, the fear is really to the upside, and I think part of that is because some people might think a floor has been put in with the last move down, so maybe nobody's expecting it to go to zero. If it goes down, maybe it goes to 80 or 70 or whatever. It's not going to zero is not the fear, but to the upside, there's not really a limit. So I feel like more people are even looking as far as potentially this being a big move to the upside, just because if they surprise. If they don't surprise, it's like, okay, well, we've planned for that already. But to go back to kind of your question, if you're long, you can almost take advantage of this type of situation, because with that call skew being as high as it is, that's better for you. If you're trying to sell something, you want that call skew to be high. It's almost the opposite in just about every case, where you have to sell a lower volatility call to the upside, it stinks because you wish you could get more premium for it. Well, guess what? In this one, you can, at the expense of giving up those potential gains. I don't necessarily think it's a bad thing, especially if you fought your way back from as low as 80. If you can sell the hundreds for $3.50, well, you're essentially looking at getting yourself $350 better. So even if we do go rallying higher, would you probably have sold it, at 103? And that's one of the things I think about, especially for like an after hours. If a stock's going to rally to 103 in extended hours and you're long it and you say, okay, just get me out, I'm done. Well, that 100 option at 350 is probably going to work out well for you, and it's certainly a lot better than if the skew was the opposite way and you had to sell it for $3. So I'll take that extra 50 cents any day of the week, to be honest with you.
So just to clarify here, are you looking at just selling the upside call, or are you looking at potentially, because you have that call that's a little bit higher than a downside put, are you potentially looking at also putting, or the potential of putting on a risk reversal because you have a higher price call?
Me personally, I'm a huge fan of risk reversal, but in this situation, I feel like the market's almost saying they're not as concerned about a downward move, and I think that's because of where it just came from. It was, what was the low, down to like 62? I don't think anybody thinks it's going to zero. So I personally would not be as interested as protecting against the downside. Now, if you've been burned once before, and it very well could go to $60 or $50, you know what I'm saying? And they've shown they know how to take the stock down. It's something that if you want to be protected against, you can use that selling of that long option to finance the buying the put. So pretty much put yourself in a collared position. The problem with that obviously becomes, if you're hoping for an upward move and you're just trying to get something back out of it, with buying that put, the total credit that you're going to receive is a lot less at 50 cents versus where it would be 350 if you just sold the call. Yep. So I don't know. That's me. I try to read a little bit more into that skew, and that's one of the harder things I think to do is really play that skew a little bit and try and figure out what exactly is it telling you. But what this is really saying to me is market participants overall aren't as afraid of a downward move. So even I think if it does move down, I don't think it's going down personally huge. So I'm not paying to protect myself in this situation.
Great stuff.
I don't have a position, though, and I haven't been burned by it from coming down from 300. So.
Says the guy who has no vested interest in it, right? So, no, but so we've only got about 10 minutes. I don't know if we can fit a call in, but if you do want to give us a call, we'll see what we can do. 877-927-6648. All the domestic calls, 877-927-6648. If you happen to be one of our international listeners, feel free to give us a call at 727-445-1044. And we kind of, I don't want to say we saved the best for last. I think a lot of people are gonna have their eyes on Apple here, which in turn, is going to draw some interest here in Amazon's earnings. I believe on the 31st. It's next week. I believe they come out on the 31st. So if you were watching Google, and we kind of foreshadowed this with bringing up Google just a little bit earlier in the session here today, one of the things, among others, right? They had basically, Google had, high. They didn't do a great job of bringing their costs in. So they were spending a lot of money expanding. I don't think that's exactly what analysts were expecting. So they came in a little bit high in terms of cost. But one of the things that a lot of people, not only in the analyst space, recognized, but also in the tech space, was that the market share in the tablet, in terms of their tablets, had actually, it didn't grow as fast as they had expected. And I think a lot of that has been attributed up until this point to the Kindle and to the Fire. So and then you also have Apple, and a lot of people are going to be keeping an eye on. I mentioned before that only about 12% or so of Apple's revenue are attributed to iPads. So I think a lot of people are going to be looking at what happens here in Apple in terms of how many units in terms of the iPad are they moving, to basically give themselves some sort of indication for how Amazon's going to do, because they, again, when Google came in and they said, hey, we didn't have as great of a tablet growth as we would have expected, that was attributed to Amazon. It wasn't attributed to Apple tablets. So Apple comes in and they say something similar. It could be really, really interesting in terms of what that means for Amazon earnings going forward. To their credit, they're also challenging Netflix. So it's like everything that we've talked about today, we talked about Apple, we talked about Google, Amazon is essentially a rival or a competitor to all of those things. They could be good or bad, but but I think it's interesting.
Well, it definitely is. And Amazon, I don't really trade Amazon that much, but it, in my opinion, is one of the most intriguing stocks out there. Like the news that they have, the products that they have, just the way that they're run as a business, I'm such a huge fan of. And if anything, it always gives you a topic to kind of discuss. But one of the things you really brought up was essentially this tablet world, right? Now, I remember as a market maker, I want to say in early 2000s, we had tablet PCs, and they weighed about 30 pounds, and they were huge, and they sucked, and nobody ever used them until Apple actually came out with a viable one, just a few years ago. But what we had was essentially, when we talk about market share, was essentially an apple pie, right? Apple had all of the market share. They were the only ones playing that game. So now we have essentially something. You have a lot more people coming into that arena. Google, Amazon, as far as the Kindle and these different kind of tablets that are out there. And one, there's market share being split up differently, but two, you're also seeing just that pie itself get a lot bigger. So the people that are actually getting in there, there's a lot more tablets being sold today than there were even just 1 year ago. And part of that, of course, has to do with Amazon's ability to get into that marketplace with a low-priced product that people actually like. I don't have a Kindle, but I know people who have it, and everybody who has one, and I don't know if it's just something where you get fired up about your own thing, but everybody who has one really seems to enjoy the Kindle, in my opinion. But going back to what you're talking about as far as what did Google say, what is Apple going to say, this is kind of one of those situations where you almost can play Apple earnings to some degree, because you would think Apple's going to move the market a little bit, right? You can play Apple earnings using Amazon. It's obviously not going to move as much as Apple because it's not direct information, but you can kind of do a similar type play with a lot less premium, but still kind of playing a directional play or even a volatility squeeze.
Yeah, you know what's interesting at the end of last year, SNL had this skit. I think it was on the Weekend Update, and they said the Kindle was going into Christmas. Kindle was expected to do well among parents who always buy the wrong thing. I saw that one. It was such a great line in comparison to the iPad that's out there. But I think if you look at the February straddle here, and I know that's not as representative of what that actual implied move is, because you actually have to go out to February. You can't look at the weeklies. It's about $17, about 10% of the underlying security. And here at 187, Amazon made basically support at the 170 level, and has some kind of upside resistance, so to speak, maybe around the 210 area. So it's kind of interesting how that's positioned in terms of what that straddle actually costs, and maybe where the actual risk is here in Amazon. Obviously, we'll be looking at Apple to see what happens, and if they don't do well but they stay inside their expected move, they just say, hey, we didn't see the growth in the tablet market that we thought as well, or the capture of the market share rather. It'll be interesting to see, how Amazon, how the market could perceive an uptick in terms of Amazon's market share there and what that does to the underlying. But in terms of the actual move based off those options, it's interesting that it's giving you a little bit of room to play in terms of where that support level is.
Right. The big thing as far as that goes is obviously you can play off the alternate products here as far as where you're going to get something to drive Amazon. But what's funny about Amazon, they talk about how many sales they had, how much volume they did in just Kindle sales and all of that good stuff. What's incredible is they don't make a lot of money on the Kindles. I want to say that for a period of time, and I don't even know if that's still the case, is they're losing money on every Kindle that they actually sell. But now what they can do is get tons of market data on everybody who's using it, and they're actually selling you stuff through the Kindle, and guess where you're going to buy it from is from Amazon. So it's kind of the Gillette model, right? You send people a free razor, and then what they do is they go and buy the blades from you forever. You know what I mean? I feel like that's really the approach that Amazon has taken.
Well, it's the same as the Google model, right? It's the same. I mean, they're not making a ton of money off selling the Google phone or the Android operating system. What they're making money on is, I think, 30% of the revenue is coming from ads on the PC, and 35, something like 30% of the revenue is actually coming from, ads on mobile. So a third of what they actually make is just coming from the ability to present ads or gather information, statistics about how the user's utilizing that mobile phone. So I think you're exactly right. It's just getting that market share and putting that device in front of as many people is ultimately going to help their bottom line.
do you feel like the writing's kind of already on the wall if we get the news from Google and the news from Apple that it's going to be like that market share went somewhere? Is it kind of saying like, okay, Amazon who's left?
Yep.
That's where it's going?
And I agree with you 100%, and this is why, because I think it's tough to say that after a holiday season in a year where the tablet was basically like this new thing, right? And you had the Kindle, which was this alternatively priced from a technology standpoint. It could do all those same things that you could do with the other tablets, but from a pricing perspective, it's like 60% cheaper than the highest price alternative. So coming off of, or basically not coming off of, this is the reports of last quarter to say that, hey, we didn't see any growth in the tablet versus the year before. It's I don't want to say it's not possible, but it's very unlikely that you're going to see less growth there in the tablet market than you did a year before, because 2011 was the year of the tablet.
And it took my mom all the way until this Christmas to buy me a Kindle.
And with that, we want to thank everyone for joining here today. We appreciate Chris Bolson. Chris, thanks for coming on. Hopefully you come on more often.
Anytime. I love it. I love doing the show. Next time, make sure you guys call in. We'll definitely get to some of your issues, positions, and all that good stuff. Thanks a lot.
Great stuff. Thanks, everyone, and we'll see you next time.